Thanks everybody for your time and attention this evening. We want to talk about how to structure your practice legally, and the general overview will be reasons to structure, or if you've got a bad business structure in place, restructure, get it right. The different types of business structures, the pros and cons of each of them. Quick overview of what is PSI as mentioned. A quick overview of the use of medical service trusts and how they work and who they work. That'll be me, and then I'll be handing over to Alexander, who'll be talking about planning exit strategies at the very beginning, pros and cons of buying into an established business, and the pros and cons of setting up a practice. Okay, the reasons we want to structure your business right or restructure is asset protection, separate the surgeon itself from the business, create space between yourself and litigation caused by possibly incompetent staff. A surgeon can be sued as an individual irrespective of their business structure though. You might want to set up a business structure to separate your assets from your personal name. So April mentioned a family trust. You may want to hold investments in a trust so that it's a separate legal entity to yourself as a surgeon or an individual. If you're sued for malpractice and perhaps your insurance doesn't cover the amount of the payout, any assets quarantined within a trust won't legally be identified with your personal name in the case of litigation. Second reason, income tax minimisation. Now, most people in this room are going to be squarely sitting in this bracket at one time or another. The idea is to structure yourself so that at least part of the income that you earn is at a lower rate, possibly the corporate tax rate, 15% superannuation concession rate. Use of trust, as mentioned, you can distribute income and access lower tax brackets amongst your family members, up and down the family tree, not necessarily just the kids and your spouse. There's a bit of tax planning around that annually before 30 June to make sure that everything goes in the right place with income. Sometimes you need to set up a PTY LTD specifically to get a contract in place. This is not a tax saving reason or an asset protection reason. This is because the person paying you the money for your services will not touch you as a sole trader or a partnership. They need a PTY LTD structure in place. But now, if you don't beat the PSI rules, the company's not going to save you any tax, but it will allow you to generate income in the first place. That income will be taxed at your normal provisional rates though. Types of business structures. Okay, the one that most medicos are pushed into from a PSI perspective is a sole trader business. Now, this is no legal separation between yourselves and the business entity itself. At law, you and the business are the same legal entity. All income is assessed to the sole trader. A second option will be a partnership, which is two or more individuals or other entities get together, form one business together with a view of making profit, splitting profits in equal or predetermined proportions. Trusts, three different broad types. There's actually fourth because a super fund is a type of trust technically. Discretionary family trust. This is a separate legal entity where the profit within that trust or the income from investments within that trust is distributed and taxed amongst family members. And it's called discretionary because the trustee has the choice each year to set which member of the family gets which amount of income from that trust. So you do a bit of tax planning each year and make sure that income goes to family members on low brackets, so that as a whole, you're paying as much tax as possible in lower income tax brackets rather than all at the 47% bracket at the very top. The fixed unit trust, these are usually used, I guess, for investment purposes, purchasing premises, things like that. The entitlement to income is fixed, so no matter what tax planning you're doing, you cannot change which member of the family gets which percentage profit share out of this type of trust. And then there's a hybrid trust, which is a sort of a combination between the two. Part of the income each year will be discretionary usually, and then they have a capital component in it as well. So when you sell an asset and wind up the trust, there'll be a fixed entitlement amongst family members for the capital gains on it. So that would be the reason for setting up a hybrid. A small PTY. So this is governed by corporations law, administered via ASIC. Potential shareholders are the owners of the business. Could be a surgeon, medico, GP, your spouse. Another entity could hold shares such as a trust. The surgeon themselves is usually a director of that business and receives a certain amount of salary. Money leaving the company is either coming out to you as wages or super and or dividends, which is just a profit share out of the business to the shareholders, however you set up in the beginning. Currently paying tax as a small business at 27.5% instead of 47%. Bucket companies, which are beneficiaries underneath a discretionary trust, which might receive a distribution, get taxed at 30%. So it's slightly less tax if you're a small business and a P2A LTD. So some pros and cons of the structures. Sole trader, really easy to operate, maintain, low cost of establishment, easy to restructure the business into something else, really easy to close it down. Just draw a line in the sand and wind it down and start something new. The cons, you'll be paying a lot of tax in that top bracket at 47%, almost no taxation relief, no asset protection. You work your whole life to build a bit of wealth. If you're sued in the business, anything in the same name as the business is up for grabs legally. And you cannot bring in a business partner to a sole trader business. Partnerships, again, simple to operate, simple to maintain, slight additional complexity over a sole trader, low cost of establishment again. There's a bit of tax savings by profit share between partners in equal proportions. So instead of a sole trader getting it all, two people, might be husband and wife, taking half each, utilising each of your lower tax brackets. You can also retire one partner, bring in a new one, and they're quite easy to shut down and restructure. There's tax relief when you roll a partnership into a P2A LTD company as well. The cons, tax effectiveness is limited by the tax bracket of each partner. You're often bound by a partnership agreement or partnership law, which means there is limited flexibility. There can be tax issues with changing partners. It's actually a capital gains event when one partner leaves a partnership and a new one comes in. So you have to start looking at values of business and what are you selling it for and how much do I make. And there's the big issue that we generally hate in our practice is something called joint and several liability. If two doctors get in partnership with each other, partner A and partner B are liable for each other's malpractice suits. So by way of example, Dr. Jones and Dr. Smith operate a partnership. Dr. Jones has all his assets in his wife's name and a trust holds the rest of the investments that he's got, and that's controlled by his wife. Dr. Smith owns her own home worth $3 million and does not invest her other $3 million assets she has via a trust. Dr. Jones, the one who does have asset protection measures in place, is sued for malpractice for $25 million. His policy pays out up to $20. There's a $5 million gap there. The joint and several liability provisions kick in. Mary is responsible for Mike's actions in the partnership. Mike has no assets in his name for the litigant. Both partners' personal assets are fair game. Mary loses $5 million over $6 million thanks to Mike, or thanks to a poor business and investment structure. So the lesson we suggest, if someone suggests a partnership, is to
don't go into partnership.
Or don't get married.
Discretionary trusts, they can be highly tax effective via income splitting and under annual tax planning work. You can still access capital gains tax discounts as if you were an individual. It's also a separate legal entity to the surgeon or general practitioner. If you use a corporate trustee involved, it's technical, but then becomes even better for asset protection purposes. It's a great vehicle for outside investments. Establishment costs are moderate, and you can also tack on a related bucket company. They call it a bucket company because it catches all extra income at 30% corporate tax rates. The cons is you're going to require some annual tax planning, so there are some additional costs involved. Usually the cost of a tax plan per annum is possibly 20% of the tax you're going to save by actually getting involved in doing it. More onerous than a sole trader or partnership, has to have the financial statements and as well as a tax return. Sole trader and a partnership don't just lodge a tax return and you can get away with it. Trust distributions need to be paid out in cash to beneficiaries. So issues here with bucket companies, when you don't pay it across, it becomes a loan, and the ATO, if you don't adhere to special rules, will go, no, we know you've not distributed to that company, you've taken it out yourself, and then they assess it all to you as an unfranked dividend in that year, and even though you're saying it's going over here at 30%, they'll assess you at 47% instead. So there's issues there to plan around. And there can be limitation as to who is deemed as being in your family for the purpose of discretionary trust distributions. Fixed trusts, some income splitting benefits, capital gains discount for large part still applies, separate legal entity again, very similar benefits as to a discretionary trust as listed there. Don't have to do tax planning because the income entitlement is fixed, a fixed trust. Again, same sort of cons as a discretionary trust really. So we won't need to really revisit them. The lifespan is 80 years as well. So if you hold a property in the family, in a unit trust within the family and pass it on from generation to generation, your children might not realise that on the 80th anniversary of owning an asset, the trust vests, which means all the assets has to be distributed out, and they could be assessed on a capital gain on a property they didn't even sell. So again, planning and advice. Hybrid trusts, mixture of both. P2A LTD, the pros are it's very high asset protection, complete separation of a surgeon from a business, limited liability for directors, corporate tax rate is 27.5%, due to drop eventually down to 25%. Very easy to transfer ownership just by a share transfer, sell a certain proportion of the shares in the company to an incoming business owner. Possibly, there are some CGT concessions available if you sell a business, but it requires some careful planning, much more difficult though than with trusts, partnerships or sole traders. Franking credits, so as opposed to every other single entity, a company doesn't lose the tax it pays. A sole trader, a partnership and a trust eventually distribute all their income out to an individual. A company doesn't, and it retains it, has a thing called a franking account. So each year your company might pay 100 grand in tax. That 100 grand doesn't goes to the ATO, but it's not lost. When you pay out a dividend, it attaches to a franking credit. In the years of low personal income, that franking credit can then, in a perfect world, be fully refunded to you. And there's a possibility of paying 0% tax in a lifetime by using a company. In a perfect world, very hard to do. Another benefit is a company can last forever. Cost to have established a little bit higher. It's got the most onerous of admin because ASIC's also involved. Again, needs financial statements, tax returns. If you pay a dividend, you've got to do minutes. And there's just more dotted lines to sign on each year. More paperwork from us. Directors still can be liable for unpaid superannuation to employees and unpaid withholding taxes. So certain businesses going insolvent will try to hold off on paying their employees super and their employees withholding taxes. Really bad idea. You're better off stringing out trade creditors in situations like that because they won't have as strong a footing against you legally if you went insolvent or into administration. Exiting the business can be a little bit more complicated. Bringing new shareholders requires a business valuation usually. Moving on to PSI, this is the issue that was mentioned by April. It's income derived mainly by a person's skill and exertion. Now this hits the medical world hard. It would hit myself the exact same way if I was a one-man band without staff and employees generating me income. Same with lawyers and IT consulting firms and things like that. We all get caught. It's just that the ATO take a hardline stance against people who are in medicine. So it applies where professional services, where goods are not often supplied. Very rarely will a surgeon on their invoice, other than maybe plastic surgeons, have materials on the actual invoice. It's all skill and expertise. So it's designed to stop you accessing tax benefits where you're really earning your income in a similar manner to being an employee, but you just set up a PTY LTD company for pure tax advantages. So income is PSI if more than 50% of that income on that invoice or contract is from labour. That's going to be you guys every single time. However, it doesn't weaken any of your asset protection, only the tax effectiveness of setting up a proprietary limited company. The HO will reverse any structure and any tax savings of an ineffective PTY Ltd company or trust. So if you're operating through a trust because your mate said it was a good idea, and again, the HO catch wind of it, you're going to repay the tax. If they deem you reckless, you repay the tax and you repay it with 75% penalty on top. So it's good to get it right at the beginning. So a structure receiving PSI from one or more people is a personal services entity, and a personal service entity that passes PSI testing is a personal services business, and a personal services business having passed the test is tax effective, which means you can beat the PSI rules in certain situations, but it's got to be a business structure earning the income rather than purely your own skill and exertion. So what's not PSI? Contracts with 50% or less labour content. If you can structure a contract where it is materials based, then you'll beat the rules straight away and won't have to even consider them. Income from supply and sale of goods, again that's a materials component. Income derived from equipment. Equipment must do at least 50% of the work. That's very hard to gauge, but a radiologist would be a good example. Operating complex and expensive machinery on every single job they do, they would straight away beat the PSI rules. Basically, the business owns the equipment that's generating more than 50% of the income. Bang, your business structure is now tax effective. The other way around it is income derived by a company or trust with as many or more non-principal practitioners, non-owners, as principal practitioners, owners. So you need to be running a practice employing more people than yourself, and these people need to be generating fees in the same way you are. Can't get around it by employing a nurse, because the fees generated by a nurse compared to a medical professional will not be in a material amount. So it often leads to us setting up practices and income sharing amongst multiple medical professionals under the one business. So what does it matter to you, PSI? Practice structures become irrelevant. You might spend a few grand setting it all up, only for it to all be undone and be completely pointless. Setup costs and ongoing costs could be a waste of money and time and effort. The HO's broad view is that you're all PSI unless you structure yourself correctly so it's a business earning the income and not a surgeon or doctor. You're all on the ATO radar, unfortunately. As soon as you put DR in front of your name, you're on the radar. So if PSI does apply to you, you need to start thinking possibly about service trusts, which is a separate business in its own right. And the business itself employs admin, nursing staff. It might rent the premises you use. It'll hold all the equipment that you might use, including vehicles. It then leases them to your sole trader business for a management or lease fee and whacks on a 5 or 10% charge on top of it. This is legal. It's a way of siphoning off a small amount of annual income from your large amount of income into a discretionary trust that can then go to your wife or kids or other family members. Small amounts every year over a 20-year period could save you 100 grand. There's slightly different rules for GPs over surgeons, and there's slightly different rules for GPs who are rural over GPs who are city doctors. They can do a flat percentage of fees straight across this service trust. So they can go 30% if you're a city doctor, straight to this service trust of the income I earn, less costs distributed to my family, and up to 45% if you're a rural doctor. So go country. And they're allowed by the ATO, yes, it's done correctly and for the reason of separating a surgeon from the liability created by employees, for example. There's a thing in the background called Part 4A, where if you establish a business structure purely for minimisation of tax, the ATO and no other legitimate reason, usually applies to restructuring when you have something bad and then try to go to something good for a tax saving. Part 4A kicks in and they'll undo what you've done. But if it's for the purpose of asset protection, that's a reason other than tax, and you just tick the box and beat the ATO. I'll now ask Alexander to come up and take over.
Talking about franking credits, Guy was mentioned. We have a number of cases where the clients ran their business through a company. The company paid tax over all those years at 30%, 27%, whatever the case may be. And now they are self-funded retirees with their own self-managed super funds, getting a tax-free pension, thank you very much, paying no tax, and we're paying these franked dividends to them, not as in cash, but in dividends, and getting these franking credits attached to these dividends. And thank you very much, Mr. Taxman, getting a cash refund. So it works wonderfully well if you structure it correctly, and that's what it's all about. Hence, planning for an exit strategy. So with these clients who are now retired business people, getting income from their self-managed super fund tax-free, getting franking credits, what's left of them, because starting to use them all up over 50 years. And thank you very much for the Christmas gift every year, 12 months. So, why is planning an exit strategy from the beginning so important? You want to minimise any impact that the regulatory authorities may well have on your business when you decide to retire. There's always going to be somebody out there putting their hand in your pocket, so you want to minimise that as much as possible. And some of the structures that Guy has mentioned will certainly assist in that pursuance. And also you want to maximise the effort of all your, I've got here, cutting and slicing over all the years, but it's not always cutting and slicing. And so you work hard, you want to maximise that return of your efforts over all those years of private and public practice. And of course, you want to leave some sort of legacy to your family, if you like, and something left over in form of assets through family trusts or private companies, whatever the case may be. So your family members may continue on with those assets. Minimisation of your taxation, obviously. And the problems with constant legislative changes. Governments never make changes. They never change the rules, never change legislation, do they? No. Good. I'm glad you all agree with that one. Buying an established practice. Why? Hopefully the structure is in place and it's compliant with the current tax rules and asset regulations and deals with the medical boards and all the other regulatory authorities that regulate our lives. You're going to go into business with people you know. You will be relying on others as well to run the business, generate an income, and hopefully they've got a good reputation. There can be issues with the distribution of profits, allocation of costs, and contribution of income or the contribution of time and the efforts that you're putting into that practice. Is it going to be equal? What kind of share is it going to be? Oh, Joe went off and had a coffee for 2 hours and I've worked in the practice for another extra 3 hours. And, So you're going to have those sorts of issues with going into practice with other people. And always do your due diligence. So important nowadays. Check insurance policies. Are they up to date? Are they current? Do they cover all sorts of possibilities that we incur in public practice? The practice itself, what history has it got? What is the history of your potential partner? Is he financially secure? Is the practice financially secure? Are there any skeletons in the closet? Are there any tax issues that are hiding there, waiting for some unsuspecting person to come along and take on the cudgels? Have there been any insurance claims on the practice? Are there any potential insurance claims and settlements and those sorts of things? The people you're going to get business with, are they of the right age? What is their mental state? And of course, have they got the right qualifications? We know that from time to time there's been an issue with doctors having got away with not being actual doctors in public hospitals. So make sure that the person has the right qualification. The premises and the equipment, are they up to date? Are they modern? Are they in good condition, with the equipment especially? And where's new technology going? Easily changeable? Is it cheap to change or whatever? It's never cheap to change. Is it obsolete already? And funding the buy-in, how do you do that? Do you ask for vendor finance? Do you have something that you can sell to buy in? Or do you go to a bank, of which there's lots of bankers here who can help us with that. Setting up your own practice. You can do it right from day one. with the right advice, getting the right structure in place. There are no skeletons in the closet because it's a brand new business, brand new practice. And you can work to your own preferences. You don't have to rely on other people to do that 3 hours. You can go, as Brian said, knock off at 3 o'clock and say, oh, look, the weather's pretty good. I'm going to go out sailing. Beautiful. You can do that. You don't have to answer to anybody. Sounds like a great idea.
You've got a list of patients.
So I'm just about done. Thank you very much. And so we take a lot for granted when we're starting up a practice, but we are all very busy people, and life seems to be getting busier and quicker and everything else. So sometimes we have to rely on other people. Don't rely on what you want to hear or what you hear. Get good professional advice because it's so critical. And of course, April is a great source of information. The website's a wonderful place, and you've got good professionals around the table and elsewhere to get advice from. Thank you very much, April, for asking us to present. Hopefully we've met some of your guidelines. And thank you very much, Rebecca and Macquarie.
Thank you very much.
Thank you.